Hello dear students, once again good morning to all of you. So in the last video lecture session we discussed about the unit number 5 monetary policy, and this is last topic regarding the unit number 5 is the fiscal policy. After this video lecture our fifth unit regarding the PEM subject will complete. Okay, so let's start. Last topic regarding the unit number 5 is the fiscal policy. So first of all, what is the meaning of fiscal policy? Fiscal policy is the mean by which a government adjusts its spendings level and the tax rate to the minor and influence to the national economy. So it is one type of, we can say, sister strategy of the monetary policy through which a central bank influence the nations for the money supply. So it's considered as the, we can say, correlated policy with the monetary policy. Monetary policy and fiscal policy both are correlated and we can say dependent to each other. So it's called as a sister policy of the monetary policy, and this monetary policy will designed by the government, and the fiscal policy will decide by the government, and the monetary policy will designed by the RBI, right? So it is a policy concerning the revenue expenditure and the debate of the, we can say, consider as the debenture and the one type of expenses like the loan interest. This all are considered as your expenditure and the debt of the government for achieving a certain objective like the control on the inflation and the public expenditure. Why this type of fiscal policy designed by the government? Because government have to try that reduce the control and reduce the expenditure like the expense on the debt fund are considered as the loan amount, then after debentures, bond. So government has to try that reduce this type of debt and liability from the country and try to reduce the public expenditure and control over that and control the inflation, right? So what is the definition of this fiscal policy? According to the Professor C.V. Raman, fiscal policy is defined as the discrimination action by the government to change, first one, the level of the government expenditure on the goods and services and transfer payment. Second one is yield to the taxation and given the level of output. Here the first, we can say, objective of the government is to try to reduce expenses and try to increase the income. Okay, so government expenditure, they have to try that reduce this type of expenditure and try to get the higher income from the taxation. So fiscal policy is defined as the consequence attempt to government to achieve a certain macro goals of a policy by altering the volume and the pattern of this revenue and expenditure and balance between them. They have to totally try to doing the balance between the expenditure and income. So the balance of payment of our country will be considered like the adjustment, right? If our expenditure is higher than income is lower, then our budget have to face a deficit. Deficit means there are the loss in our country, and if they have to be maintain this type of policy, so they have to reduce deficit in the, we can say, country, right? Then what are the objective of this fiscal policy? First one is a full employment. It means that the main power is ready to work at the privileged wage rate without any dispute. So the government increase the public expenditure to rise the demand and tax rate decreases. So this result, the private sector gets the initiative to spend a more where the aggregate demand increases and the total production and the employment is increased like the Manrega. So in the last video lecture regarding the unemployment, we learned about the scheme of Manrega. In this you have to learn that government doing the various type of expenditure that try to reduce the poverty and unemployment in our nation. So first objective of this fiscal policy is to doing the full employment in our India. Second one is the reduce in economical inequality. The prominent aim of this fiscal policy is to remove the economical inequality so that burden of the such tax is generally forced on the rich people. So they have to try to doing this type of create the equality between the poor peoples and the economical upper class people. So they have to reduce the economical inequality through this fiscal policy. Then third one is the price stability. When the price is rising, then the inflation is exist in the economy. So its aim is to be a decrease the demand and the expenditure on the tax rate is increased. So the extra purchasing power of a people goes into the hands for the general public and the demand decreases because there are the excess supply of the price. So automatically go down the price and fear of the stock. So they have to try to reduce price as so they can control on the overall the market. Then economical development. To achieve development of a country, fiscal policy act as the source of capital formation because as a capital formation is in increase the production and the employment are also increased. If there are the higher we can say capital formation is doing. Capital formation means what? First of all, capital formation means what? There are the savings. Okay, we can say publics have the saving. Then after saving is converted as the investment. Saving and investment both are the different things. If you have the money and you have to store in your we can say cupboard and in the cupboard and bank, so it's considered as your saving. But if you invest your saving in the different bonds, different mutual funds and different companies, so it's considered as your investment. Then after if you invest in the different companies, so company get the we can say money fund. Okay, money fund, they have to get the money fund, and if they have to get the money fund, they can invest in the different production activity, and so that if they have to be require the higher production, so they have to require the employees, so employees can get the job and we have to reduce the unemployment. So from saving to the capital formation is a one type of process are considered, and we can say if there are the doing this type of saving to investment activity, then employee can get the job. Then after, what are the tools of fiscal policy? So tools of fiscal policy, first one is a public revenue, second one is a public expenditure. Public revenue through the revenue receipt, capital receipt, then revenue expenditure, capital expenditure. Revenue receipt is considered as a tax, non-tax. Tax has to consider direct tax and indirect tax. So let's see it. First one, public revenue. Income of government from the all sources is called as a public revenue. There are the two types. First one is a revenue receipt, second is a capital receipt. So what is revenue receipt? Receipt means income that generated by the government from the public. So government receipts which are neither credit liability or nor reduced assets is called the revenue receipts. So these are processed from the tax. If a government levied the tax, they have to consider the income. So it's considered as a revenue receipt. Interest and dividend on the government investment, cease and the other receipts from the service rendered by the government, that you have to consider that if you have to idea regarding the house tax, so if you have to see the receipt of our BMC, Bhavnagar Mahanagar Palika, then they have to consider the education cease, right? So education cease means what? જે ગુજરાતીમાં લખ્યું હોય છે શિક્ષણ ઉપકર, તો એ વન ટાઈપ ઓફ સીઝ ઇઝ અ વન ટાઈપ ઓફ સીઝ. એ સીઝ એટલે શું કહેવાય? એક જાતની ઇન્કમ છે જે ગવર્મેન્ટ જે છે એ જે સર્વિસ આપે છે એના થ્રુ જે સફાઈ વેરો છે, પછી તમે ગુજરાતીમાં લખ્યું હોય છે સફાઈ વેરો, શિક્ષણ ઉપકર, તો એ બધા સીઝ જે છે એ એક વન ટાઈપ ઓફ ગવર્મેન્ટનું ઇન્કમ છે, રિસિપ્ટ છે. This current income is received from the government from the all sources, like example of taxes, interest received, fees, fines. This all are considered as the revenue receipt. Second receipt is then after second receipt is a tax. So in this first one is a tax. So financial charges or the levies imposed by the unknown upon, we can say that taxpayer. So there are the direct tax and indirect tax. Direct tax, these are the tax are directly paid to the government by the taxpayer, so it's called the directly tax. It is tax applied on the individual or the organization directly by the government, like the example income tax, corporate tax, wealth tax, good and service tax. These all are considered as the direct tax. Then indirect taxes, these are applied on the manufacture or the sales of the goods and services. Example, there are the sales tax, custom duty. These all are considered as the indirect tax. Then after non-tax receipts are those revenues receipts which are not generated by the taxing the public. So interest which are government is earned on the money and lent by the external internal borrowers. Example, interest receipt, fees, fines, this all are considered as a non-tax incomes of the government. Like if you cannot wear the helmet, then government have to tax on it, right? You have to pay the fine. So this fine is one type of income of the government. Then after capital receipt. Capital receipt is refers to the receipt which entire, we can say, either to be a created a liability or goes to the reduction in the assets of the government. Example, recovery of the loan. If government have to provide the loan, then they have to be a like get the money. So it's called the recovery of loan. Second one is a disinvestment. Disinvestment means what? Means government have to invested their money in the different sector, and if they have to be a discontinue their investment, they have to be a withdrawal their investment from this sector, so it's considered as a disinvestment. Then after borrowing, if government has to borrow the money from the public and from the financial institutions, so it's called as a borrowing. Then provident fund. So if you heard the name of PPF, means public provident fund, this facility provided by the post office for the public, that if any public and any person cannot have the particular segment job like government job and private sector job, so they can invest their money in the PPF, public provident fund, and get the return after the 60 years. So it's a one type of, we can say, policies that government can get the money as an income. Then after the public revenue, second one is a public expenditure. Expenditure means what? That government doing the expense on the public, like public expenditure is the spending made by the government of the country on the collective needs, wants such as the pension, provisions, infrastructure, like revenue expenditure and capital. Like we can say in the public receipt, we know that revenue receipt and capital receipt. So in this there are the revenue expenditure and the capital expenditure. So budget of the government expenditure, first one is a revenue expenditure. Revenue expenditure means what? Expenditure which neither create or asset or not reduce the liability is called a revenue expenditure. First one is a payment of interest. So government, if the government can get the borrowed funds, so they have to provide the interest on it. So it's payment of interest. Second is a payment of the salaries and pension. Government, we can say, employees have to get the salary from the government. So this type of payment is considered as one type of revenue expenditure of government. Then grant and subsidies. Government also provided the grant and subsidies to the particular sectors. So also that they have to be a one type of expense for the government. Then education and health services. Government, if you know that in our Bhavnagar there are the one city hospital and the government hospital, they can only provide their health facility and healthcare facility within the minor charges like 2 rupees and 5 rupees, right? So there are the excess, we can say, expenditure is what have to bear by the government. So it's considered as the revenue expenditure. Then after defense services, government provide the defense services, and for that they have to consider the various type of expenses like the equipment of the defense, then after salaries of our army soldiers, right? Then capital expenditure, expenditure which create the asset and reduce the liability. First one is the constructions of road, bridge and building. If government doing this type of and consider this type of project, then they have to renew and generate the new assets, right? Second one is the purchase of land and machinery. So they have to doing the expense and get the land and machinery as an asset. Then investment in share. So they have to consider the we can say one type of shareholders, as a shareholder they have to work, right? Then loans to the state and the foreign government. If a government provide the loan to the government, so it's a one type of capital expenditure and they will get the as an interest rate. Then repayment of loan. If they have to doing the repayment of loan, so they can easily we can say doing the repayment, so it's one type of expense for them and they have to reduce the liability. Then review of the India's fiscal policy since independence. So on the initial year, India's planned development strategy, the growth of the was ineffective. In the starting phase, our growth was very ineffective. Then indirect tax were larger source of the revenue than the direct tax. We cannot get the direct tax. We have to consider the indirect tax in the starting years. Then the fiscal deficit for the 2010 and 11 is declined from 5.1 of GDP, and the 2011-12 fiscal deficit is to be a target was 4.6, means we have to face the deficit, we can say consider we have to bear the loss from starting phase of our independence. Then here there are the direct tax and indirect tax and non-tax amounts are given from 1997 to 2005 and 6. So here you see there are direct taxes increasing nowadays and indirect tax are decreasing. Then non-direct tax are continuously according to the, we can say, penalties, and we can say we have to find from the non-taxes, right? So they have to be maintained, but direct tax is nowadays increases and indirect tax are decreases. So here there are the one graph regarding the government expenditure over the last decades budgeted, for the budgeted versus actual is given to you. So here you see there are the blue color is indicate the total expenditure budgeted and total actually done. So from 2013, from 2003 to 2013, 2012 and 13, you see that our budgeted expenses we can say is lesser and our actual expenses is higher, right? So nowadays we have tried to reduce this type of expenditure which have to consider by the government, so government can easily take the decision to reduce the total expenditure and try to doing their budgeted, we can say whatever they have to assume that this type of this amount we have to invest and using this amount, so they have to try to reduce this type of expenses in the market. Okay, so thank you very much. Here our fiscal policy topic regarding the unit number 5 completed. So here our unit number 5 also completed. So if you have any query regarding the unit number 5, any topic regarding the money, banking, monetary policy and fiscal policy. So monetary policy and fiscal policy both are very important according to GTU examination. From between we can say among these two, one can ask by GTU examiner. Okay, so you can learn about it. If you have any query, you can ask me. Thank you very much.